Welcome back. Thanks for joining me. I'm Sean, and this is not financial advice. And today we are going to be doing another episode, a speed run of some stocks subscribers have asked me to review. So I'll ask you to hit that like button. Go ahead and subscribe to the channel and turn bell post notifications on as it's an open offer. If there's a stock that you'd like for me to review, take a look at, make sure that you are in fact subscribed with the bells on, as I'd be happy to do a video for any one of you, and then you'll be notified when it's posted. So what we're going to do is start today's video with a quick update on my portfolio. Today, the market was down 0.75%, and my portfolio was down 0.5%, with the NASDAQ composite down 0.56% and the Russell 2000 flat. Today, looking at my portfolio down at this point, $350 today, what we can see is outperformance from some marijuana companies. Curaleaf Holdings and Trulieve led the pack, gaining around 3.5%. And my worst performer on the day was Walgreens, down 5%. So overall, the market today was liking some things that have been volatile, like Coinbase, also liking consumer defensive Dollar General. But there's also some strength in individual companies such as Texas Roadhouse or Target, more cyclical stocks. Um, some tech that had recently sold off is up, and then things like gold miners, Wheaton Precious Metal is up. So overall, I think it was a pretty uneventful day in the stock market. No real discernible trend on the gainers. And as far as things that went down, it was everything from defensive to technology and Amazon or technology in Google, but also seeing defensive names like Kroger going down. So nothing too groundbreaking, and I think the market's just trying to find its footing. So we're going to be reviewing 3 of our subscriber stock requests here during this video. But what we're going to do is take a look at some company-specific news on my portfolio, and then we're going to dive right into it just after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
Okay, today is probably the second day that marijuana stocks have been doing good here in early January of 2024. As of 2 or 3 days ago, there was a report that the DEA had ordered more THC for testing. This is presumably to continue studying the review the FDA, under the direction of the Biden administration, had made, instructing the FDA and the DEA to possibly reschedule marijuana as a Schedule 3 substance, which would give marijuana companies the ability to write off expenses on taxes, boosting their earnings per share and cash flow in the future. And so today, marijuana stocks moving higher with some interesting news. DEA is confirming that they're reviewing marijuana rescheduling recommendation to Congress, that they have the final authority on marijuana rescheduling. And so I'm not really sure why they're taking that tone with the public. I guess because they're a militarized law enforcement agency, that's has some tough guys in it, so they want to be in charge. So I guess that does make sense. On Walgreens, they did a great job reporting earnings today that beat both on earnings per share as well as on revenue. So they beat earnings per share. Expected was 62 cents, reported was 66. Revenue expected was 35.1 billion, reported 36.7 billion. Now under a new CEO, this Tim Wentworth was the former executive, I believe, at a health insurance company, and so he's seen as a pretty competent guy. And not sure how much impact he had on this quarter. Maybe some, but additionally, he made the tough decision to go ahead and cut their dividend in half, which is never a great sign, especially in the short term. Companies that raise their dividend tend to do better over a near and intermediate period of time. At the same time, what we can see with Walgreens is that they were paying close to an 8 or 9% yield. And so the yield's going to go down to just 4 or 4.5%. And I think if he's making hard decisions, the survival of Walgreens Boots Alliance is now much less in question that he's making these hard decisions. So I won't be selling. Now, to get into what some of you came here for, let's go ahead and start taking a look at some of the stocks selected for review by some of our subscribers here. The first one was Citi Group, and this is one that I think is interesting. Over the last 5 years, the stock is down pretty big, and let's just take a look at some of the news. So they had a good quarter and went up 4%. This was in the dark ages. Citigroup stock has been oversold, and then you saw the stock rise 68% from the COVID lows. And then shares group jumped 7% after Warren Buffett reveals a $3 billion stake in the company. So he could have bought there at 70 or there at 58, probably somewhere around and maybe as low as 51. So he probably bought somewhere between $50 and $60, which caused the stock to go up. But then additionally, U.S. bank stocks sank as Credit Suisse fears spur renewed rout down 5% that day. And then Citi soars after revenue targets remain even after trading slump. So really some up and down things, and definitely things that have probably brought people's attention to the stock, particularly Buffett buying. And so let's get over here to Qualtrim. Um, Qualtrim is a software that I pay for to look at stocks, but not one I'm affiliated with. So I'll leave a link for Qualtrim below. But here at Qualtrim, we're going to be able to take a look at some of the facts and figures on Citigroup to sort of see what we can see and see, what would inform this investment decision. Maybe see some of the things that Buffett saw or thought about when he invested. And so, right off the bat, I want to draw attention to the 3.8% yield, 3.9% yield, and it's at a very safe 33% payout ratio. So, right off the bat, this seems to be a really good dividend stock. And so that could definitely be something that someone could be considering when they've looked at this stock. And so over the last 10 years, there haven't been any dividend cuts. Um, I can see here that they did cut in the great financial crisis, and they paid a very a high yield. Um, And I think that the banking sector on the whole is more regulated and more safe after the global financial crisis. Um, and it's a complicated subject, but it can, involve regulations, stress tests, even things like PMI on mortgages, um, and things of that nature. So as of about 2016, it looks like they've had a dividend policy. And so overall, this dividend looks pretty good to me. That is, in fact, a check mark. But coming back over here, we can see that Citigroup is a large cap company. We can also see that it has a forward PE of just under 9, which is pretty affordable. And then we can see that it has a price to book of 0.54%. My understanding is that means that the market cap is 0.54% of all the assets that Citigroup owns. So it's trading cheap on a price to book basis. Correct me if I was mistaken there and you know more than I do, but also trading cheaply on a price to earnings basis as well. Now, what we can see here is some weird looking stuff when it comes to free cash flow yield. And I saw some inconsistency there, so we'll talk about it. But What I do like seeing is they have more cash than they do debt, and so that is a positive thing. So let's get down here in Qualtrim and look at some of these other financial performance metrics that are important. So their revenue's been flat since 2002. That's not great. So that's going to be an X. Looking at free cash flow, banks are cyclical and this is inconsistent. But they really seem to be flat somewhere along this 35 billion a year in free cash flow. But with many years in recent history when maybe they shouldn't have had negative free cash flows. So um, they do have a track record of producing free cash flows, but this chart is just a little bit too inconsistent for me, and so I'm going to rate it as an X. Looking at earnings per share, it's a pretty interesting picture. And I don't know enough about this particular company to understand why their earnings per share were so high and 20 years ago. Obviously, you had the great financial crisis there. But in looking at the performance since that time, everything looks pretty good. And so, looking past the great financial crisis, the earning per share looks better than the free cash flow, at least in recent times. So, I'm going to give this a green check mark, though not a very strong one. Over here, we can see cash and debt. We can see that their cash is going up and their debt has gone down in the last 10 to 15 years. And so I'm going to be giving this a check mark as well. Now, looking at shares outstanding, this kind of presents um, a little bit of a interesting picture. Um, they issued a lot of shares at the end of the GFS, and since then have been buying them back steadily since 2014. So for about 10 years, 10 or 13 years. So if we look over the last 10 years, um, they have been buying shares back, and that will be enough to get this stock, Citi Group, a check mark on shares outstanding. Lastly, looking at return on capital employed for this company, this bank, it's pretty low. I'm not sure what is standard within the banking industry. So I'm going to give it a red X, but this may not be as relevant of a metric per se in the banking sector. So if I was wrong, sorry. Looking at profit margins, these actually look pretty healthy, and it looks like they are going up and to the right. So for profit margin, Citigroup gets a green check mark. Now, with that being said, I do feel pretty comfortable doing DCF valuations of companies. I can even value companies based on earnings per share or on dividend, a dividend discount model. But when it comes to valuing banks, that's quite hard. At least I feel it is. That's my understanding. The right way to value banks is either on a price to book multiple or possibly a return on tangible asset multiple, and it's just not something that I understand, and so I'm not going to try to do it. But I like Morningstar, and so they had some words to say on Citigroup, which is trading at $54. And so I'm going to bring in a clip from Morningstar to see what their thought is on the value of this $54 stock. Do take a note that this video was done as of 11 months ago, but nothing has seemed to change dramatically since then. So I think we can take it with a small grain of salt, but let's see what they have to say.
Our final undervalued value stock hails from the financial services sector. It's Citigroup. Citi is the most undervalued traditional U.S. bank that Morningstar's analysts cover. The bank is shedding its non-performing assets, refocusing its operations, and working through consent orders from regulators. It's also building up capital in response to higher capital requirements and bracing for a possible global recession. But although the bank is facing headwinds, we think a recovery in card balances and the bank's institutional clients group business will drive revenue growth. We think shares are worth $75. For more stock ideas, be sure to subscribe
to Morningstar on YouTube, as well as Not Financial Advice, my channel. Hit that like button, subscribe to the channel. So with all that in mind, although I, am unable to give a fair value estimate on Citi Group, I thought that it might be instructive to look at what is widely recognized as the, best in class peer in that banking sector. And so, well, Citibank was down 8 or 9% over the last 5 years. JPMorgan Chase is up 72%. And so it must be a lot of good news. We won't delve into the key events here, but we can just see a different performance, a totally different looking chart. Let's see if the fundamentals over here on Qualtrim look significantly different than Citigroup, and see if that can inform our opinion. So looking at JPMorgan Chase over here on Citigroup, what we can see is revenue, a chart that looks a lot better. We can see stock-based adjusted free cash flow actually looks pretty similar to Citigroup, and so this might be a bank-specific thing. And again, this isn't the primary way that you value banks. With that in mind, their earnings per share look quite a bit better. Look quite a bit. I showed the 10-year chart on Citigroup. They look similar or better than Citigroup as well. We can also see less share issuance, um, or almost no share issuance during the global financial crisis, and then a track record of buying back shares. So this looks like a more sound institution in that manner. And then this was a similar chart that I saw looking at the all-time view on Citigroup for return on capital employed. And these numbers are actually similar to Citigroup as well. And so, yeah, that's just why I'm sharing this. This is not my area of anything close to expertise. But also looking at Citigroup, they have a nice 2.5% dividend yield, but only a payout ratio of 25. So more dividend growth could be expected here. And so for all these reasons and more, this is why this particular bank stock has outperformed. And so if the subscriber was, thinking about investing in individual bank stocks, unless you work at a bank or know a lot more about it than me, I'll share what I do. So I invest in VFH, which is Vanguard's financial ETF. And so I'll just go here to the portfolio composition, 397 stocks, and they're diversified broadly across different financial companies. But if we look at their top 10 holdings, we can see Berkshire Hathaway. There's a group of folks that know how to analyze banks. And so I'm happy to see them lead VFH, where I make my bank investments. But then JP Morgan Chase second, also getting exposure to things like Visa and MasterCard, where we're going to have an upcoming video. But then other banks, with Citigroup not being among the top 10 holdings as their market cap is too low. So this is the way that I choose to play it. That's just me, not financial advice. Like the video, subscribe to the channel. Now, enough on that. We are going to move on to the next requested stock, which is Intellia Therapeutics. Okay. And so we can see a lot of volatility in this stock. A lot of people, this probably came onto a lot of people's radar somewhere around this time when it went up 200%, or, something that goes up 652% gets people's attention and stays in the back of their mind. So let's just see what we can learn about the stock. Before we do that, I wanted to come over here to Investopedia and do a quick read through on biotechnology stocks. That's what this NTLA ticker is. So biotechnology stocks have the potential to provide investors with incredible returns. Biotechnology firms use living organisms to manufacture products. Biotech and pharma companies produce medicines, but pharmaceutical companies usually have a chemical basis to those medicines. Biotech stocks have the potential for significant investment gains if a product is deemed safe and effective. However, biostocks also come with risks that some products under development may never make it to market or end up having problems and getting recalled or problems with the FDA. And so firms face many regulations, including the FDA, and the added risk of uncertainty surrounding developing new drugs. So that timeline, or what's in their pipeline, rather, as far as drugs that are going to um, patent and how long those patents last. Those are some of those important metrics in looking at pharma and biotech stocks. The only one I own here is Vertex Pharmaceuticals, but biotech and pharma stocks are kind of like the scratch off ticket for the investor. And generally, I think it's best to just avoid them for all the reasons stated here, unless you have particular insight. Maybe you work at a pharmacy. That would put you in a better position to look at individual companies. But otherwise, when we're looking at Intellia Therapeutics, won't be spending a lot of time on this because although revenue has gone up a modest amount, like 11% a year, they have no free cash flow. They have worsening and negative earnings per share. They do have a good pile of cash, but they're massively diluting shareholders, 12% over the last 5 years, and they have no return on capital employed. So I would never look into the stock any further than this, and so I hate it. Sorry about that. Um, Moving along, here's some different thoughts. If you're someone who is looking at NTLA, you could consider an ETF. So this is the XBI State Street Spiders Biotech ETF. But note how it's performed really poorly over the last 5 years, up only 9%, probably with a very, minimal, if any, dividend yield. So that just shows you some of the challenges of the biotech sector on a whole. Looking at pharmaceuticals, also has had sort of substandard returns as well. And so the way that I play this is through Vanguard Healthcare, which owns smaller amounts of biotech and pharma stocks, but also things like United Healthcare, an insurance provider, which has had quite decent returns with a reasonable dividend over the last 5 years. And so that's my last word on that. Thanks for submitting that one. Everyone else, make sure to like the video and subscribe to the channel. And we're going to get to our last stock of the day we're going to be looking at together, which is AES Corp. So this is a seemingly regional utility company, owns power plants, etc. They've had fairly lackluster returns over the last 5 years. Let's see why that might be over here on Quiltrum. Looking at AES, they have declining revenue. They don't have free cash flow. They have inconsistent or negative earnings per share, and decent returns on capital employed, but expenses going up as well. And so they're not diluting shareholders, but when I see when I see revenue going down and not a lot of free cash flow, um, it just doesn't make me thrilled about this company. I wouldn't necessarily look into this too much further. I will say, though, that you have insiders buying around the $16 mark. And so if you work at this power plant and you know more than I do, it could be something worth a closer look. But I simply play this through Vanguard Utilities VPU. Um, well, AES is up more than VPU. Um, I can see here that AES has a 3.5% dividend yield, but it looks like they're sort of going into debt to pay for that. As far as VPU goes, it has, a nice dividend yield. It has modest performance. The total returns, make it something like 5, 6, 7% a year. And utilities rather are a great place to be because they're considered the bond of stocks. They're most inversely correlated to the market, so it can be a great ballast in a portfolio. But let's just take a look at how I play utilities in owning VPU. So they're selecting these companies based on a market cap. And so the top holding in VPU is NextEra Energy. So we saw that there was negative free cash flow and declining revenue growth with AES, declining revenue growth and negative free cash flow. Let's just compare this utility company to the top company in VPU and see how they're doing. And so here, it looks like free cash flow is a problem across this industry, but you see revenue that's going up. And you can see that their dividend yield is safe as opposed to AES. And so that's why I choose to own the index. But hey, with all that being said, thanks so much for tuning in. Make sure to like the video, subscribe to the channel.